You know, that feeling, that sort of economic uncertainty that seems to be, well, everywhere right now.
It's definitely palpable.
Yeah, and it's something a lot of us are feeling. But it's probably worth remembering this isn't exactly new, right? Humans have always kind of looked for ways to handle anxiety, especially about the future, about scarcity.
Absolutely. It's baked into us, really. This drive to build systems, create order. It's a response to that fundamental uncertainty. We see it throughout history.
Okay, so let's unpack that a bit, because one huge system we built going back, what, over 400 years?
That's right.
Is the capital markets. And they were designed essentially to deal with exactly these kinds of tensions, weren't they? Like scarcity, but also abundance, worry even when things seem okay.
Precisely. The capital markets were, frankly, an ingenious solution for that time. A way to pool resources, manage risk, allocate capital on a much bigger scale than before. It shows how we create these complex tools to handle economic challenges.
And that's really what this deep dive is about today. Understanding how these markets have, changed over time, but more importantly, how they're maybe becoming more accessible for people like you listening.
Right.
It's not just some far-off financial thing anymore. It's potentially something you can actually participate in, share in the growth, not just watch from the sidelines.
And that gets us right to the core idea, the democratization of investing. The notion that the chance to build wealth through these markets shouldn't just be for a select few.
Okay.
And our source material today, it's actually a letter to investors, dives right into this. It traces how investing went from being, well, pretty exclusive to something a bit more within reach for more people.
So our mission, let's call it, for this session is to pull out the key takeaways on how investing got more accessible and maybe what the future looks like for even more people getting involved. Ready to jump in.
Let's do it. So maybe start at the beginning, the origins of this whole democratization trend.
Yeah, good idea.
Well, the Amsterdam Stock Exchange opening in 1602, that's generally seen as a really key moment.
Right, and this is where it gets super interesting, I think, because before 1602, investing was pretty much just for, wealthy merchants,
Okay,
right?
Overwhelmingly, yes.
But Amsterdam, it was different. Okay, sure, maybe 90% of the first investors were still the wealthy elite. But that other 10%, that included ordinary folks, artisans, shopkeepers. The source even mentions silk weavers, soap makers.
Yeah, and two maids who invested a pretty significant chunk of their income, relatively speaking.
Exactly. So this was really the first time that door to owning a piece of the economy, a real share, started to open up beyond just the richest tier. A huge shift, fundamentally.
It's such a stark contrast to what came before. This wasn't just about lending money. It was about actual ownership, a stake in these new companies, in their potential success. It changed who could even think about participating in growth.
And it wasn't just Amsterdam doing this in isolation. When the idea hit England, the London Stock Exchange, it didn't start in some fancy palace.
No, famously not.
It started in a coffee house, Jonathan's Coffee House, in a place called Change Alley. You can almost picture it, right? Bishops rubbing shoulders with bookkeepers, farmers maybe even still with mud on their boots.
Yeah, probably.
All there investing in things like the new Bank of England.
That image really hits home, doesn't it? It shows that people from different walks of life were suddenly getting access to something revolutionary, a real tradable piece of the action, of economic growth. It wasn't just something happening to them anymore. They could be part of it.
Okay, so let's fast forward 4 centuries. The change in participation is, well, it's massive. First half of the 20th century in America, maybe 1% to 4% of people own stocks. Tiny.
Really small.
But since the mid-70s or so, that number has shot up. Today, it's roughly 60% of Americans. That's a colossal jump in who has a stake.
And if you zoom out, this huge growth in market participation happened during basically the biggest period of wealth creation in all of human history, global GDP. It grew more in the last 40 years than in the previous 2,000 years combined.
Wow. That's a statistic. But it'd be nice if that rising tide lifted all boats equally, wouldn't it?
Yeah.
The source material is pretty clear that this huge wealth creation, it hasn't been shared evenly. It actually talks about twin inverted economies existing in many places, big disparities.
And that's a really critical nuance.
Yeah.
Yes, globalization, expanding market, they definitely pulled millions out of extreme poverty globally. That's undeniable.
Right.
But at the same time, particularly within wealthier countries, it often widened the gap between the top and everyone else. So you get this feeling, this narrative that, yeah, capitalism generated vast wealth, but maybe the benefits didn't trickle down to everyone.
Which leads straight into that central argument in the letter, the idea that capitalism did work just for too few people.
Exactly.
And the answer, according to this perspective, isn't to ditch the whole system. It's to make it broader, to actually finish that democratization process that started way back in Amsterdam.
That's the core message. Expand access. Let more people get a meaningful stake in the growth that's happening around them, rather than throwing out a system that clearly can create wealth.
Okay, so the letter lays out broadly 2 ways to push this democratization further. First, help the people who are already investors get into parts of the market they couldn't reach before. And second, just get more people into the system, period. Help more people become investors in the first place.
Right, let's tackle that first one. Unlocking previously restricted areas, specifically private markets. Historically, if a business or a big project needed money, it didn't primarily come from capital markets like we think of stocks and bonds today.
Where did it come from then?
Mostly banks, other big corporations, governments. Those were the main funding sources.
Okay. But the source mentions that back in the late 80s, the team founding BlackRock saw things differently. They thought capital markets wouldn't just be like a sidekick to the banks and governments.
They saw them becoming a co-equal source of capital, a parallel powerhouse, essentially.
And why did they think that?
Well, the underlying logic, which is largely played out, is that over the long haul, capital markets tend to offer better returns than, say, just parking money in a bank.
Right.
Those better returns pull in more investors. More investors mean deeper markets, more available capital.
Yeah.
It creates this kind of positive feedback loop.
We're seeing the result of that now, aren't we? There's this mismatch. Huge demand for investment capital, but the traditional sources, governments, banks, they're constrained. Governments have debt issues. Banks have tighter lending rules. Yet there's this enormous pool of, quote, idle capital just sitting there. The letter mentions something like $25 trillion in the U.S. alone, just parked in banks and money market funds.
It's an astonishing amount. And it does echo that situation back in Amsterdam, doesn't it? Just like that early exchange could have done even more if there were more companies listed.
Right.
Today, that $25 trillion is a vast potential resource that isn't fully participating in growth because the accessible investment opportunities are limited for many.
Exactly. The very assets that are really defining the future, think data centers, ports, power grids, those fast-growing private tech companies, they're mostly locked up in private markets. Behind these big walls, high minimum investments, income requirements that most investors just can't get over.
And the traditional reasons for that exclusivity make some sense historically. Risk, illiquidity, meaning you can't just sell out easily.
Yeah, you're locked in.
And just general complexity.
Yeah.
These things made private markets mainly the playground for big institutions or the very wealthy, people who could afford the risk and didn't need immediate access to their cash.
But the letter kind of pushes back on that, suggesting these barriers aren't set in stone. Private markets don't have to be so risky or so opaque or so hard to get into.
Right.
And that seems to be the thinking behind some big moves BlackRock has made recently, buying firms involved in infrastructure, like GIP.
Global Infrastructure Partners, yeah.
And a private credit firm, and even a company called Prekin that specializes in data about these private markets.
It signals a pretty significant strategic shift, moving from being mostly known for traditional stocks and bonds, index funds, ETFs,
Public market stuff,
to having a really substantial and growing footprint in private markets. It's key to their whole democratization vision.
And infrastructure seems like a really big piece of this. I mean, you think about history, the railroads in the 19th century, the interstate highways later, huge drivers of growth.
Absolutely. And the scale of what's needed now is just mind-boggling. The estimate mentioned is $68 trillion in global infrastructure investment needed by 2040.
$68 trillion.
To try and put that into perspective, the letter uses this analogy. It's like building the entire U.S. interstate highway system and the Transcontinental Railroad every 6 weeks for the next 15 years.
Okay, that's hard to even grasp. It just highlights the sheer size of the need and why private money has to be involved.
Exactly. Governments are already stretched, dealing with deficits. They can't foot that whole bill.
Not even close.
And even the biggest tech companies, the trillion-dollar giants, they can't finance it all either. Building just one big AI data center can cost, what, $40 or $50 billion?
Yeah, massive costs.
And frankly, a lot of these tech firms would rather focus their capital and expertise on their core technology, not on becoming massive infrastructure builders themselves.
Right, stick to their knitting.
So that creates this huge opening for the markets, for private capital, to step in and fund these essential projects.
And investors are definitely interested. Infrastructure is apparently one of the fastest growing areas for investment.
It is.
But we're back to the same problem. Most of these projects, only accessible through private markets. High minimums, wealth restrictions, locking most people out.
And that lack of access gets worse when you consider that fewer big companies are even going public these days. The traditional IPO, it's less common.
Really?
Yeah, source says 81%, huge majority of large U.S. companies, those with over $100 million in revenue, are actually privately held, not listed on the stock market.
Wow, 81%.
And the trend's even stronger in Europe and the UK.
So where are these private companies getting their funding, if not from the public markets or traditional bank loans as much?
Well, that's where private credit comes in. Essentially lending that happens outside the traditional banking system or public bond markets. That sector is booming, expected to more than double by the end of the decade.
Okay, another huge growing area that individual investors are mostly watching from the sidelines.
Pretty much. Which brings us to how people actually build their investment portfolios and how that might need to change. For ages, the gold standard has been the 60-40 portfolio, right?
Right. 60% stocks, 40% bonds. That's like investing 101 for a lot of people. Based on modern portfolio theory, diversify to reduce risk, don't put all your eggs in one basket.
Exactly. The idea is that stocks and bonds often move differently, so combining them smooths out the ride.
But the letter argues that maybe, just maybe, in today's evolving financial world, that classic 60-40 mix doesn't give you the true diversification it used to.
So what's the alternative they're suggesting?
Well, the potential new standard floated is more like 50-30-20. So 50% stocks, 30% bonds, and 20% in private assets.
Bringing in that private piece.
Yeah, things like real estate, infrastructure, private credit, the stuff we've been talking about.
And what are the supposed benefits of adding that 20% private slice?
Well, take infrastructure again. It can potentially act as a hedge against inflation, which is a big concern for people. It also tends to be less volatile, less jumpy than public stocks day to day.
Okay, stability.
And historically, adding even a bit of infrastructure seems to have boosted overall returns for portfolios.
Interesting. But there's a practical problem, right? The investment industry itself isn't really set up for this 50-30-20 world for the average person.
That's so.
You've got your traditional firms, they're great at the 50-30 part, the stocks and bonds, the ETFs, mutual funds.
Yeah, the everyday stuff.
And then you've got these specialized private market firms that handle the 20%. The infrastructure funds, the private equity, the private credit, they operate in a different world, really.
So it's siloed. And for an individual investor trying to get that 20% piece, it's almost impossible to bridge that gap, especially in a diversified way.
Exactly. Even if you somehow scrape together the minimum for one private infrastructure fund, putting 20% of your whole nest egg into that single illiquid thing.
Yeah.
That's not diversification, that's concentration risk.
Good point. Yeah. So how do you solve that?
Well, the letter draws a really interesting parallel here. Looking back at another divide the industry managed to bridge, the old split between index investing and active investing.
Oh, yeah, I remember that. Back in, 2009, BlackRock bought Barclays Global Investors, BGI, which created iShares, the big ETF brand.
Right. And at the time, the industry was pretty fiercely divided. You were either team index, low cost, just track the market.
Set it and forget it.
Or you were team active, pay higher fees for managers trying to beat the market. They were seen as totally separate, almost opposing philosophy.
Yeah, very tribal.
But BlackRock's move was apparently based on this insight. Even choosing an index fund is an active decision. You're actively choosing which index, which market slice, how much risk. It's not truly passive.
Huh. That's a good point, actually.
And by putting both active strategies and index tools like ETFs under the same roof, they gave investors way more flexibility. ETFs stopped being just these simple passive things and became core building blocks for all sorts of portfolios, active or passive.
Okay, I see the connection. So the argument now is we're at a similar point with public markets versus private markets, another artificial divide.
That's the parallel they're drawing, just like they helped bridge the index active gap. The opportunity now is to bridge the public-private gap.
And acquiring GIP, the infrastructure firm, is positioned as like the first big step in erasing that boundary.
That seems to be the narrative, yes. bringing significant private market expertise and assets directly into their fold.
And GIP owns some pretty major stuff, right? Like actual physical assets.
Oh yeah, big things. London's Gatwick Airport, for example, energy pipelines, data centers all over the world.
Wow.
And crucially, the letter stresses these assets are owned on behalf of their clients. It's the client's capital that's funding this infrastructure, and it's the clients who benefit from its performance.
Okay.
There's also mention of a recent deal, an agreement for a huge network of 43 ports in 23 countries, handling a big chunk of global shipping containers, partnering with major shipping companies.
So these acquisitions are about giving their clients, potentially eventually smaller clients too, more direct routes into these private markets.
That's the stated goal. But there's another piece to this puzzle, the opacity problem. Private markets have historically been, well, murky.
Hard to see what's really going on.
Exactly. Hard to figure out what an asset is truly worth at any given time, which, understandably, makes investors nervous.
Makes sense.
The analogy used in the letter is great, I think, trying to buy a house before Zillow existed.
Huh. Yeah, okay, I get that. You had no easy way to see comparable sales market trends. You were kind of flying blind.
Right. That lack of transparency has definitely held back investment in private markets.
So how do you fix that? Is that where the Preqin acquisition comes in?
That's the idea. Preqin is basically a massive database for private markets. It tracks fund performance, who the managers are, comparable asset valuations. It aims to be that Zillow, or maybe even the Bloomberg terminal, for private assets.
Bringing light into the black box.
Pretty much. And the long-term vision, apparently, is to use all this data to eventually create indexes for private markets.
Indexing private markets, how would that even work?
Well, conceptually, if you have enough data on enough assets, you could create a representative basket, just like the S&P 500 represents the broad U.S. stock market. Make them more accessible, easier to understand, simpler to buy and track.
Okay, that would be a game changer.
The hope is that this transparency and potential for indexing would attract a lot more capital, get that $25 trillion off the sidelines, and speed up what the letter calls the prosperity flywheel, benefiting investors of all sizes.
This whole shift, integrating public and private, using data, it feels like potentially a really big moment. The letter even compares it to BlackRock's founding when they built the Aladdin risk management platform.
Yeah, that first platform, built by one employee on one computer back in '88, it gave investors a unified view of portfolio risk in a way that hadn't really existed before. It fundamentally changed things.
They're suggesting 2025, this period we're in now, could be another one of those pivotal moments, another major reshaping of the financial landscape.
That's the implication, driven by this integration of public and private markets. But it's not just up to asset managers, right?
What do you mean?
The letter makes the point that the future shape of all this will also depend heavily on economic rules, government policies, how countries decide to attract and deploy capital. It's bigger than just finance firms.
Right. Which kind of brings us back to the individual, doesn't it? And maybe the most common way people interact with investing, retirement.
Exactly. The focus shifts now to the individual investor's experience. Starting with retirement savings, it actually references the origins of Social Security, a letter written during the Great Depression by Francis Townsend.
Ah, history again.
And Social Security has been incredibly successful at its original goal, preventing widespread poverty among the elderly. It's lifted millions out of hardship.
Absolutely vital. But
there's still this deep anxiety. Over half of Americans, the letter says, fear outliving their savings more than they fear death itself.
wow, more than death.
Yeah. So while Social Security provides that crucial safety net, it was never really designed to create substantial wealth or long-term financial security on its own.
So the argument is we need more than just a safety net.
The letter argues the U.S. needs to focus just as much on building a ladder, a way for people to actually grow their savings through investing. And for most people, let's be honest, their 401k, or equivalent retirement account, is their main, sometimes only, real experience with investing.
True.
So if you're serious about democratizing investing, retirement savings have got to be front and center. And the stats are, well, they're worrying. A third of Americans have no retirement savings. Public pensions are often underfunded. People are living longer.
Yeah, it's a tough picture.
Which is why BlackRock held this big retirement summit in D.C., bringing together employers, policymakers, academics, unions, trying to find practical fixes. And three main areas emerged.
Okay, what were they?
First, expanding emergency savings, which makes total sense, right? hard to save for 40 years from now if you're worried about a car repair next week.
Definitely. Need that cushion first.
So things like the Emergency Savings Initiative, the Secure 2.0 Act are good steps, but maybe simplify the rules more, raise contribution limits, make enrollment automatic.
Makes sense. What's number 2?
Closing the gap for small businesses. Half of Americans work for a small business.
Wow, half.
Yeah. But nearly half of those small businesses don't offer any retirement plan at all.
That's a huge gap.
It is. Some states are creating incentives, which seems to be helping, but more policy support is probably needed.
And the third area?
Helping people start investing earlier. There's this idea called baby bonds, basically, giving every child an investment account at birth.
I've heard of that. Proposed by Senators Booker and Young, right?
That's the one. The letter suggests revisiting it. Even a small amount, starting early, could grow significantly thanks to compounding. And maybe more importantly, it gives everyone a sense of ownership, a stake in the economy right from the beginning.
Interesting idea. Changes the mindset, potentially.
Could do. Now, here's another startling number from the letter. The average amount Americans think they need to retire comfortably.
Oh, I bet this is high.
Almost $2.1 million.
2.1 million. Wow. Okay.
Yeah. And the tough reality is most people, even older Gen Xers nearing retirement, are nowhere near that goal.
Oof. So how do we bridge that gap? Does this come back to those private assets again?
It does. The letter points out that big pension funds, the ones managing retirement money for teachers, firefighters, etc., they've been investing in things like private real estate and infrastructure for decades.
Right, the 20% allocation we talked about.
Exactly. And that's a big reason why those pensions often outperform typical 401ks year after year. It might only seem like a small difference, maybe 0.5% annually.
Doesn't sound like much.
But over 40 years of saving, that 0.5% compounds massively. BlackRock estimates it could mean an extra 14.5% in your 401k balance by retirement.
14.5%, that's huge.
It translates potentially into funding an extra 9 years of retirement income.
9 years. Okay, so why aren't these private assets common in 401ks if they make such a difference?
Well, historically, a few reasons. They're less familiar to the companies providing 401ks. And there are practical challenges with valuing them daily or letting people withdraw money instantly, which 401ks need. Liquidity, again.
Right. The plumbing is different.
But the argument is that technology and market structures have evolved, and including these assets in 401ks is becoming much more practical now, especially recently.
Where would you start?
Target date funds seem like a logical place. You know, those funds that automatically adjust your mix of stocks and bonds as you get closer to retirement.
Yeah, very popular.
Because they have a really long investment horizon, especially for younger savers, they're well suited to hold some of these less liquid long-term private assets like infrastructure.
Okay, that makes sense. But saving the money is only half the battle, isn't it? What about spending it in retirement?
That's the other huge challenge, especially for 401k savers. You retire, you get this big lump sum, and then what? How do you make it last potentially 20, 30 years? It's actually considered one of the hardest problems in finance.
Yeah, I can imagine. Unlike a pension.
Exactly. A traditional pension just sends you a check every month, makes the guesswork out. But with a 401k, the fear of running out of money often leads people to underspend, to live more frugally in retirement than they maybe need to.
Because they're scared of outliving the pot.
Right. So to tackle this, the letter mentions a solution BlackRock developed called LifePath Paychecky. It's basically an option within a target date fund designed to turn those accumulated 401k savings into a steady monthly income stream, more like a pension.
Trying to replicate that security?
Sort of, yeah. It's still early days, but some big companies are starting to offer it. And the need for these kinds of solutions is only going to grow as more and more people rely solely on 401ks for retirement income.
Okay, so we've talked about accessing markets, retirement. But the letter also touches on real-world roadblocks, right? Things that stop investment from actually happening.
Yes, it pivots to the practical challenges. Using infrastructure permitting as a key example. Getting approval to build things, especially big energy projects in the US and Europe. It can take an incredibly long time, sometimes longer than the actual construction.
That seems counterproductive.
It really can be. The comparison given is stark. Getting approval for a new high-voltage power line in the U.S. takes, on average, 13 years.
13 years, just for the paperwork.
Pretty much. Whereas in China, it takes a fraction of that time. Or think about high-speed rail. California's project has faced decades of delays and ballooning costs, while China built thousands upon thousands of miles in a similar period.
Yeah, the contrast is striking.
And these delays in energy infrastructure are becoming critical now because electricity demand is surging, partly driven by AI data centers.
Ah, the AI factor.
Utilities are already warning they might not have enough power in some states. Silicon Valley Power apparently had to pause requests for new data center connections because the grid couldn't handle it.
Wow, so we could actually face problems powering things.
The letter warns of an unacceptable trade-off if we don't invest enough in energy infrastructure, basically. Having to choose between powering the machines, driving the economy, and powering people's homes and existing businesses.
Not a good choice.
Not at all. So it calls for energy pragmatism. That means fixing the permitting bottlenecks, yes, but also taking a clear-eyed look at the energy mix we need. Renewables are crucial, but we also need reliable, dispatchable power sources that can run when the sun isn't shining or the wind isn't blowing.
Which brings up things like nuclear.
Exactly. Nuclear power has actually declined in the U.S., even though there's potential with new small modular reactors.
Meanwhile,
China's investing heavily in nuclear. They see it as key to decarbonizing their industries and becoming a leader. They're also surging ahead in the EV market. Look at BYD overtaking Tesla in sales. They could dominate that global market.
It really highlights that connection the letter mentions between a country's wealth and its energy consumption. They're deeply linked.
Very much so. Then the focus shifts briefly to Europe. BlackRock has a long history there, manages a lot of assets for European clients.
Okay.
And for about a decade, the economic outlook for Europe has been, well, pretty gloomy. Lots of pessimism.
Yeah, that's been the narrative.
But the letter points out an interesting observation attributed to Mario Draghi. Sometimes trade barriers within the EU between member states are actually higher than barriers between the EU and outside countries.
Really? That seems odd for a single market.
An IMF analysis apparently backs this up, but there's a glimmer of optimism. Europe seems to be waking up to the need to tackle these internal regulatory roadblocks.
And if they do?
The potential upside is huge. The IMF thinks reducing those internal barriers just down to the level seen between U.S. states could boost Europe's productivity by almost 7%. That's like adding $1.3 trillion to its economy.
Wow, just by streamlining internally.
Plus, AI could be a big help for Europe, too. With its aging workforce challenges, AI boosting productivity in service industries could be a major tailwind.
It's interesting. Now, the letter also wades into crypto a bit, doesn't it? Bitcoin and the U.S. dollar.
It does, yeah. It acknowledges the huge benefit the U.S. has had for decades from the dollar being the world's reserve currency.
A massive advantage.
But then it expresses concern about the U.S. national debt growing faster than the economy and the rising cost of just paying the interest on that debt.
Yeah, those numbers are getting scary.
The caution is that if the U.S. doesn't get its fiscal house in order, people might start looking for alternatives. Assets like Bitcoin, other digital currencies, could be seen as safer havens, potentially undermining that dollar dominance and America's economic edge.
So it's not necessarily anti-crypto, but sees a potential risk to the dollar if debt isn't controlled.
Exactly. It actually calls decentralized finance an extraordinary innovation that can make markets faster, cheaper, more transparent, while still flagging that potential risk to the dollar status down the line.
Okay. And that leads into the final big technology piece, tokenization.
Right. This is presented as potentially revolutionary for investing.
Explain it simply. What is tokenization?
It's basically representing ownership of a real-world asset, like a stock, a bond, a piece of real estate, maybe even art as a digital token on a blockchain.
Okay, like a digital certificate of ownership?
Kind of, yeah. But one that can be traded and transferred almost instantly, peer-to-peer, potentially 24/7.
What's the big deal about that?
Well, imagine if every asset could be tokenized. Markets could operate continuously. Settlements, which currently take days for stocks, could happen in seconds. Trillions of dollars currently locked up waiting for transactions to clear could be put back to work much faster.
Faster, cheaper markets.
And more democratic, too. That's the key link. Well, fractional ownership.
Meaning?
Instead of needing, say, $1 million to invest in a commercial property, maybe you could buy a $100 token representing a tiny fraction of it. Opens up assets that were totally inaccessible before.
Ah, okay. Democratizing access.
Right. It could also make shareholder voting easier if voting rights are embedded in the token. And it could democratize yield, make it easier to access higher return investments by removing some of the traditional friction and intermediaries.
So the vision is tokenized funds become as normal as ETFs are today.
That's the expectation expressed in the letter, yeah.
Yeah.
Though it hinges on solving challenges like reliably verifying who owns the token's digital identity.
Got it. So, wrapping things up, the overall arc is this long move towards more democratic finance, but it's not inevitable.
No, the letter makes that point clearly. It uses that historical example of the London Stock Exchange trying to restrict access back in the day, and the public pushing back successfully. Democratization isn't guaranteed. It needs constant effort, vigilance.
A journey, not a destination sort of thing.
Pretty much. And BlackRock positions itself as committed to that effort, acting as fiduciaries for their clients.
And the final takeaway really emphasizes the power of these markets, doesn't it?
It does. It highlights how capital markets, despite flaws, have generated immense wealth for many, how investment fuels the infrastructure, the businesses, the tech that ultimately benefits individuals. It's a virtuous cycle.
Creating that prosperity flywheel.
And the closing thought is quite profound, I think, that investing isn't just about hope. It's about what makes our hopes for the future possible. That's why protecting the system, expanding it, democratizing it, is so important.
Okay, so let's try and quickly recap the main threads here from this deep dive. We've seen this long historical sweep towards investing becoming more democratic, starting way back in Amsterdam. We looked at the current big push, trying to unlock those private markets infrastructure, private credit for more investors, partly as a way to boost retirement savings, which is another key focus area.
Right, addressing those retirement gaps.
Yeah, and then we touched on these potentially transformative technologies, especially tokenization, that could fundamentally change how assets are owned and traded, lowering barriers even further.
It paints a picture of continuous evolution, driven by both market forces and technological innovation.
And for you listening, the relevance is pretty clear, right? These trends suggest a future where you might have more choices, more opportunities to participate in economic growth through investing than ever before. Those old walls are slowly coming down.
It points towards potentially more pathways for building financial security, which is relevant to almost everyone.
Definitely. So maybe here's a final thought to chew on. As these lines blur, between traditional finance and this newer, decentralized, tokenized world, what kinds of investment opportunities that seem totally out of reach today might actually become part of your portfolio in the years ahead?
Interesting question.
And maybe what new skills or knowledge might you need to navigate that changing landscape? Something to think about.
Food for thought indeed.
Yeah.
Until next time.